this example, we're going to journalize our adjusting entries for our merchandising business. Now, this isn't much different than when we learned adjusting entries back in Chapter 5. The only difference is now is we're doing it for a merchandising business. And in this particular example, all we're doing, the adjustments, the hard part's been done. The adjustment columns have already been completed on the partial worksheet, and we're just journalizing it. So the first two adjusting entries we have to make in a merchandising company are to remove the beginning inventory, because this beginning inventory of $45,000 is no longer accurate. So we take it out of merchandise inventory and put it into income summary, and then we enter our new merchandise inventory, which is $50,000. So we debit merchandise inventory and credit income summary. So our balance in merchandise inventory now becomes the correct ending balance of $50,000. Then it looks like we had some unearned revenue. The fact that we're debiting the unearned revenue here, if you find our unearned revenue, this means that $2,000 of this unearned revenue has now been earned. So we're taking it out of our unearned liability revenue account and we're putting into our revenue account, grooming revenue. Then we use some supplies. You can see your supplies account here. We use $7,000 worth of supplies. So this is a refresher. When we use the supplies, we credit or decrease the supplies account and debit supplies expense for the amount used. We're going to record depreciation of $5,000, so we find our depreciation. And remember, we debit depreciation expense and we credit our contra asset account, accumulated depreciation. Nothing happens to our actual building. And then we have some wages that have been earned but not yet paid. So we need to go ahead and expense them. The matching rule tells us we have to expense in the accounting period in which it was incurred, but we haven't yet paid the wages, so we're going to credit our liability account wages payable, showing that we owe $1,200 in wages, which we will pay in the following accounting period.